Same data, two sharply different verdicts. As 2025 draws to a close, the National Bureau of Statistics of China released economic data for the month of November, saying the indices point to a sustained, steady development momentum with progress. But a recent Wall Street Journal analysis, based largely on the same official data, paints a very different picture. It argues that China's economy is deteriorating, that the growth momentum has weakened across the board, that consumer demand is faltering, and that exports are now doing most of the heavy lifting for the world's second largest economy. Which story is closer to reality? Is China's economy stabilizing or quietly losing steam? Are we looking at resilience and structural upgrading, or at growth increasingly propped up by external demand? Welcome to this edition of The Point with me, Liu Xin, coming to you live from Beijing. I'm pleased to be joined from Portland, the US, by Professor Liang Yan, Kremer Chair Professor of Economics at Willamette University. From Oslo, Norway, by Carl Fay, Professor of Strategy at BI Norwegian Business School in Oslo, and here in the studio, Professor Gong at the University of International Business and Economics. The warmest welcome to all of you. So let's dive into that article and looks at how it came to the conclusion. Now, the Wall Street Journal article quotes quite some numbers, mostly in retail sales, industrial output, fixed asset investment, property investment, average home prices in 70 cities, and urban unemployment rate. It mostly showed a downward trend year on year, but no positive, not at all. For instance, the article says that there is a market weakening of consumer spending. Retail sales grew only 1.3% in the month of November, down from 2.9% in October. But if you look at the overall statistics released by the National Bureau of Statistics, there are many other numbers. For instance, in terms of retail sales from January to November, total retail sales of consumer goods rose by 4.0%. Retail sales of services also up by 5.4%. Let me go to Professor Liang Yan first. It appears to me that there are many bright spots in the official data, but none of these make their way into the Wall Street Journal article. Is this cherry picking? What was your first reaction when you read this article?
Well, I think this is nothing new. Wall Street Journal has been very critical about Chinese economy all years. And so I think this is, like you mentioned, they selectively really sort of enlarge the number in November, but not really looking at the big picture. And I think you're right. I think this year so far, the first 3 quarters, China's real GDP growth was 5.2%. You've seen this industrial output growth and retail sales growth all at a steady and healthy pace. And the year is very likely to wrap up with around 5% growth rate. So I think it is a bright sort of spot in the economy where you not only have stable growth, but more importantly, you have this industrial transformation. You have this industrial upgrade. When you look at, high-tech manufacturing, for example, that growth rate is more than double the average output growth in the industrial sector. And I think, in terms of the retail sales, I think November's number is a little bit weak, but let's put that in context. I think there are a number of factors. One has to do with the high base effect. Last year, this time in November, there was a trading program that was rolled out. And so that really helped to stimulate the retail sales growth. And there was also a lot of purchases that were being front-loaded. So when you look at the number, what really seemed to go down is the household appliances. That's gone down by 14%. Automobile, that has gone down by about 9% in November. But again, this is because a lot of the purchases have already been done earlier in the year. So again, a month doesn't really show a trend, right? So I think it is some kind of a blip at this point. And of course, I think other parts of the economy, especially when it comes to export growth, is very robust. And I would also add, Another slight weakness in the economy right now has to do with the real investments. That has gone down quite a bit this year to negative 2.4%. But I think that is way to optimize investment growth going forward. So nothing of this is really sort of showing the economy is stalling, as some of the media would point out. It does show some slowdown in the very end of the year, but that does not, again, wipe away this entire year's growth.
Carl, let me turn to you. Exactly what is the story behind consumer spending in China? For instance, I didn't mention online sales from the month of January to November are up by 9%. That's a lot. And again, services in terms of retail sales are up by 5.4%. How should we understand the trend of China's consumption?
Well, as is often the case, there are some positive signals and some negative signals, and so it's possible to pick the more positive ones and the more negative ones. On the negative side, I continue to be most concerned about the property sector, but the Chinese government is taking some steps to deal with that. I mean, down with property investment down about 15.9% over the last year. I would like to see the Chinese government accelerate letting the property companies that need to fail. It's a question of, do you do it quickly or do you do it more spread out, and what policies do you put in place to make that more stabilized? But in some ways, it's a good thing that you're seeing this, because traditionally we have seen an awful lot of the sales of houses be new build. Whereas in most economies, it's more of a mix between new build and selling already existing property. So I think we're seeing, some stabilization, some changes to the more global norms. If you talk about retail sales, one of the things in China is that Chinese people tend to save more money than people in many countries. So some of the issue is, can you make it confident for Chinese people that they actually can spend more money? They normally can spend more money than they do. And I think, some additional confidence is one of the reasons that we see the online sales going up so much. And finally, just to mention that I think one of the most impressive things is, in the face of very high U.S. tariffs, China has managed to sort of shift where they're exporting to get a lot of countries along the Belt and Road to buy more, especially in places like Africa and so forth. And this shift in demand, I think, is impressive to show that China's not dependent on any particular one country, but actually has attractive products that everyone's interested in.
Yeah. Well, we're staying with consumption here, and Professor Gong, are Western analysts applying outdated consumption benchmarks to China? If so, what should be the relevant benchmarks be, given how affordable, for instance, retail goods are here in China?
Well, 1 month's number doesn't mean anything to me. I mean, it's fluctuating from month to month. And I totally agree with Professor Liang Yan that we need to look at the overall figure here. I think, Chinese consumption is indeed growing by above 4% overall, just for goods, and services even better than 5%. That's a very impressive growth for such a large economy on an annual basis. The November temporary pullback number is very much tied to the ending of the incentive program, the subsidy program, these tax rebate programs. So this is a temporary pullback, and I would think that the continuous growth momentum will continue towards the end of the year and into the next year. So I think, if you look at the overall Wall Street article, it basically mentions three things. One is about consumption, which we have already rejected, right? The second thing is about the exports. Exports, it's only about 15-16% of China's GDP. It's not able to pull the China's economy as a whole. It's a nice add-on. Professor Fei is talking about China's reaction to America's tariffs, and we are very good in terms of weathering through this very difficult time. The overall exports still increasing, but nevertheless, it's a small percentage of China's GDP. It's not going to pull the economy out of the problem, as a whole. The third thing I think it's worth mentioning is really about real estate market, and it's not denying that it is indeed declining. And this has to do with the overheating of the real estate market in the past, has to do with the declining population, demographics change. And he also mentioned the fixed asset investment. This is also a real estate story, basically. I mean, a bulk of the fixed asset investment is indeed tied to the real estate market. And so what? I mean, the real estate market currently represents, I think it's 7% of China's GDP, and we would like to see this percentage to further decline as our economy is undergoing a profound transformation, essentially. I think we're talking about new productive forces, the development of these sunrise industries, things related to AI, high-end manufacturing, robotics, these things. If you look at the statistics from the Statistics Bureau, these sectors are undeniably increasing at a very fast pace, right?
Exactly.
Way more than 5% growth on a year-to-year basis. And as a matter of fact, the products from these industries are showing up in Western markets. Look at the exports of EV cars, for example. Right. It's showing a very impressive progress in the European market. Yeah. I was really shocked to see a statistic coming out of UK saying that the top 10 most popular models, new car models sold on the UK market are actually Chinese. 3 of them are Chinese models. So these are manifestations of how China's economy is undergoing profound changes for the better, for sure.
Well, the Wall Street Journal article and other similar articles likewise says nothing. It mentioned nothing about the transformation. It only talked about the traditional sectors, the housing, the retail of consumer goods and so on and so forth. But what China has been doing deliberately is to suppress quantity and improve quality, and especially fostering the so-called high-tech, high-quality productive forces, basically new and high-tech sector, to increase proficiency and the future-oriented industries. So in the November numbers, there are a lot of numbers related to this transformation, and yet none of them can be found in the Wall Street Journal report. Let's look at just a couple of them. For instance, high-tech and equipment manufacturing are growing far faster than traditional sectors. In November, equipment manufacturing grew 7.7%, and high-tech manufacturing expanded by 8.4%. Professor Liang, does this prove that China's industrial upgrading strategy is working, or does it mask weakness elsewhere in the economy, as some might speculate?
Well, I think that definitely shows the strength of China when it comes to industrial upgrading and fostering this high quality productive forces. And I don't think this masks so-called the other weaknesses, because I think what China aims to do is to buy these kinds of industrial upgrading, right, fostering this emerging new tech, and also integrate these general purposes tech into the traditional sector in order to really improve the so-called total factor productivity in the economy. So what that means is that you'll be able to create more value added, you'll be able to create more productive and also skilled jobs, which means the wage level, right, will rise, because these are productivity, high productivity kinds of work. And so that would come with, better job creation and more wage increase. And so that would definitely help with the demand side. Because again, I wanted to emphasize on the sort of long-term trend, right? So when you look at since 1995 to 2025, China's average annual consumption growth is around 9%, between 8 and 9%. That's almost triple the world average. And when you also look at the consumption to GDP ratio, I know a lot of the Western observers point out China's consumption to GDP ratio is way too low. But I think they forgot 2 things. One is that China also has large amount of the so-called in-kind social transfer. So in other words, a lot of services that are provided by the public sector. So that adds another 6 to 7% of GDP. Exactly, healthcare. I'm just going to mention that because when you look at healthcare spending out of the total consumption in China, that's about 9%. Look at the United States, it's about 16%. whereas the two countries share about the same life expectancy, about 79%. So in other words, again, Chinese people are spending, they're also enjoying these high quality products and services. And yet, the service is a little bit sort of undercounted in the total consumption. And I also want to mention in terms of the material well-being of China, and again, when you look at just by single products, by product categories, right? Because again, prices sometimes could be distorted and could be also subsidized. But Chinese people pretty much share the same level of consumption of protein. And China actually per capita basis, we consume more air conditioners than actually American consumers. And also when it comes to mobile phones and automobiles, China's per capita consumption is about half of the US, despite the per capita GDP is only about 1/5 of the US. So given all that, I think there's this myth about China's consumption is too low and the households is being suppressed and so on and so forth.
Right.
Now, that said, I definitely agree there's more room to boost the household consumption. You mentioned about deposits. Right now, there are about $23 trillion worth of household deposits in the bank. And just this year alone, there has been an increase about $946 billion. So this is really, I would say, pent-up demand, right? That we could boost consumer confidence and help them to unleash some of these demand.
Yeah. Well, let's get back to some other eye-catching numbers that the Wall Street Journal has clearly ignored. For instance, output of 3D printing devices rose by over 100%. For industrial robot, it's up more than 20%, and for new energy vehicles, John, you were talking about it, it's up 17%. So, Carl, let me ask you, what do these numbers tell you? Do they represent genuine transformation, or are they still too small to offset broader slowdowns?
No, I think these numbers show a really impressive story. One of the things that's important is, what's actually more important is not how China is performing today, but how China is going to perform in the future. That's what we really care about. And of course, how it performs today is some signal of that. But this transition to higher value added is really impressive. If we move back a decade, 15 years ago, there was much more production of sort of low value added activities. China very smartly realized that to be able to pay the higher salaries that people wanted, one had to have higher value added in their manufacturing. And this push towards high quality productive forces, innovation essentially, was a really important one. I think, if you would be talking 15 years ago, people would be wondering, could China actually make this transition to really not only being the factory of the world, but also the innovator of the world? China also, maybe some would question, could there be companies that are Chinese companies that are selling products? If we move back some decades, it was China producing for Western companies. But now we see this shift towards Chinese companies themselves becoming global brands. Now, there's still some, improvement that's needed there. But for example, I was very impressed that now in 2025, China is producing more than half of the world's EVs. I was impressed to see how China is doing in robotics, now becoming clearly the leading producer of robotics in the world. And, you often talk about cheap labor costs, which are going up a bit, but still reasonably inexpensive compared to world levels. But we see, for example, that the number of robots per 10,000 people has moved from about 97 in 2017 to over 500 now in China for 10,000 people. So we see a real shift there that is happening. And you look at the green transition and all that China's doing there, where it's over 80%, 70 to 80% of the output is produced in China of solar cells and wind turbines. So we really see China moving into this high-end, value-added, high-tech production, and that's not only helping China now, but more importantly, helping China in the future.
Well, we have to be objective and look at the overall picture. There are bright spots, of course. There are also the not so performing well numbers. And if you look at some of the charts, although we discredit the behavior of looking at month-to-month numbers, you have to look at the trend over the past year, since last November, for instance. And we are seeing, for instance, industrial output, for instance, the growth of industrial output did slow slightly in November at 4.9%. The momentum did moderate across the board for the second half of this year, together with a host of other factors. So, Gong, let me come to you here. What are the factors behind these trends? They are slowly going down. Okay, there are indices. Is this normal? Was this expected?
Well, I would interpret this very cautiously by looking at 4.9% declining to 4.8% over a month. Does that represent a trend? Absolutely not. I think we at least need to observe for 2 quarters to discern a certain pattern here. So I'm not so convinced that the industrial output is indeed slowing down. Having said that, though, let me also point out that if you look at, I'm really looking at this from an economist's point of view. If you look at the overall economy and look at the people's consumption, I think a large portion of it is still very much tied to the traditional things like real estate, like food, like transportation. These are big ticket items in a consumption pattern. So these things will remain pretty much unchanged as we move forward, even though we're talking about these new productive forces, these sort of sunrise industries. The question for the Chinese economy is that the rise of these sunrise industries will be quick enough to compensate for the slowing down of these traditional things that are driven very much by the population change, by the demographic change. And that's a big challenge in my view, because the new stuff is still a very minute portion of the overall consumption in the grand scheme of things. So I think this is a big challenge, and I think that this is one area that the government can play some role in sort of accelerating this sort of transitional trend. And I think the important thing here is that we look at the China's industrial growth, the expansion of its manufacturing capabilities, not so much influenced or deterred by these Western media bad-mouthing. I think there's a concern in general in the West that they see the rise of China's manufacturing in these areas as a big threat to their sort of traditional dominance in those manufacturing sectors. And the idea of sort of pushing back Chinese exports in those areas is very popular in the West. I mean, I just came back from a trip in Europe, talking to some think tank people, and they generally view that China's trade balance with European countries is something of a long-term consequence to these countries in terms of their implications for their jobs, for their business viabilities in these sectors.
Well, a very quick word on China's exports, because in November, China really broke record to register trade surplus, a record high of over $1 trillion US, yes, for the first 11 months of this year, and overall foreign trade went up by 5.9%. But the primary trading partners, or the primary growth, has come from ASEAN countries and African countries, as Kao-Fei was talking about. Professor Liang, how do you look at this, exponential growth? Did China seek the trade surplus, first of all? And secondly, is there this expectation that China is going to rely on exports instead of internal demand and upgrading to boost the long-term prospect of its economy?
Right. So the 2 questions that you ask here, for one is, I think this export performance does show that China's trade competitiveness, and China has been doing 2 really important things. One is to upgrade its trade structure, meaning that it has been improving its industrial value added. And we know the new trio, the new 3 things, right? The solar panel, the NEVs, and also the batteries, they have grown the fastest. When you look at November, they grew by 33% in terms of exports, so way higher than the general 6% of total exports. Right. So that kinds of upgrading has made China's products very competitive, right? Over 60% of China's exports are electronic machinery. And second is China was able to diversify its exports. And I think Kao-Fei's mentioned earlier, right? The export to the United States have gone down by 28%, but the exports to Africa, Southeast Asia economies, and so on have gone up by a lot. So that just shows the resilience of China's exports. Now, whether or not China really needs to rely on export, well, I think, first of all, China's export dependency ratio is about 19%, which is lower than the world average of 29%. And I think this idea that China relies on trade exports, I think that really maybe described China in the 2000 to 2010s, but that's no longer the case. And you look at the net export, right, the surplus, you mentioned about 1 trillion, but out of the 19 trillion economy, that's about 6%. So it wasn't as large as what some of the media would like us to believe. And last but not least, I think again China is making this transition, that it is making all these new products. But when you look at, for example, the NEVs, China's domestic sales was 11.6 million so far this year. Export 2%. So in other words, the domestic consumption take up about 85% of the total sales of EV. So Chinese domestic market is still the major source of the kinds of consumption demand. And last but not the least, let me just conclude here. I think it's also important, to understand that all these overcapacity issue. I think again, it is a fear, and it's rightly so, because the Western economies needs to get their act together to be able to compete with China. And I don't think the so-called overcapacity is really sort of China's intentional strategy to take people's lunch, right? To take other countries' lunch. But this is a way that China's strategic focus on manufacturing capacity, but also, try to expand domestic consumption and domestic investment in terms of optimization of investment demand.
Okay. Well, looking ahead to 2026, Carl, what will convince you that China's economy is truly back on a sustainable growth path, and what would make you change your mind?
So first of all, I think it's really important to understand that we're talking about, is China's GDP growth going to be 5%, 5.1%, 4.9%? Most countries in the world would be dreaming about this. So this is one of the issues. One talks about a potential slowing down by 0.1% or 0.2%. China is still doing quite well, overall. It's natural that it can't go on at 7% GDP growth forever. For me, what I would like to see is I'd like to see the Chinese government take even more action dealing with the real estate sector. They're already doing some things there. I would also like to see consumer confidence get even stronger. There are some trends that it's positive, but let's be honest, there also are some concerns out there. As I mentioned before, Chinese consumers actually save more money than most people in other parts of the world. And so trying to persuade consumers that they, can actually spend some more is actually something that will be good. It's also important to point out that Chinese people have invested so much of their savings in the real estate sector, right, much more than most people have. And so one good thing about the real estate problems is it's pushing people to diversify a little more, to invest a bit more in the stock market, to invest more in different things. And so I think also if we can see some additional reforms to increase the liquidity in the stock market, this would also be something that would be helpful and that hopefully the Chinese government will continue to work on.
Finally, John, the IMF actually uplifted its forecast for China's growth in 2025 from 4.8% to 5%, 5.0% for this year. And for next year, it's a similar story. They uplifted the expectation. What does that say? I mean, between the IMF and the Wall Street Journal, who is closer to reality?
Well, IMF did this correction last month, and they figured out that if they didn't correct this number, they would be missing the number because we are on target to achieve 5% growth. So they're actually following up with the real statistics that have been showing so far up until November. I think, there's no doubt that 5% is going to be on target, maybe even a little bit more. But let me put it this way. I think, moving forward to 2026, I think, this about 5% growth target is still going to be quite achievable in my view for the next 3 to 5 years. And I think if we can do that, it's already a big achievement. China's economy is increasingly becoming a developed economy. And if you look at the growth rates of developed economies, I mean, 3% is quarter growth. Very good year. It's a spectacular growth for 3% for an economy like the United States and European Union countries. So we are going to be more like this, and this kind of a growth is already pretty good.
So definitely China's economy is not deteriorating. That means from bad to worse, something that's much higher than what many Western economies are able to achieve. We have to leave it here. Professor Liang Yan, Carl Fei, and Professor Gong, thank you very much for being with us. And that's it for this edition of The Point with me, Liu Xin, coming to you from Beijing. As always, you can follow me on Facebook and X using handle Liu Xin in Beijing. On behalf of the whole team, thank you for watching. You've got The Point.